Imagine a bomb, a financial explosive device so large it makes the 2008 subprime mortgage crisis look like a firecracker in a teacup. This bomb isn't hidden in some obscure derivatives market or buried in the ledger of a fraudulent crypto exchange. It is standing right in front of you. You drive past it on your way to work. You see its shadow on the sidewalk. It is the office building downtown, the shopping mall in the suburbs, the hotel that feels just a little too empty. Right now, the United States is staring down the barrel of a $2 trillion debt wall. That is the amount of commercial real estate debt maturing by the end of 2026. This isn't just about landlords losing money. This is about the collateral that underpins the entire U.S. regional banking system turning into, quite literally, concrete dust. We are witnessing the slow-motion demolition of the American city as an economic engine. But the most terrifying part? The banks know it. The Fed knows it. And they are praying you don't figure it out before they can exit the burning building. Welcome to the silent crash. The question isn't, will the bubble burst? The question is, who is going to be left holding the bag when the dust settles? To understand why your local bank might be insolvent, we have to look at how we got here. For over a decade, following the global financial crisis, the world lived in an era of ZIRP, zero interest rate policy. Money was essentially free. If you were a developer or a private equity firm, you could borrow hundreds of millions of dollars at 2% or 3%. This environment created a dangerous illusion. Investors, desperate for any kind of return, poured trillions into commercial real estate. They bought office towers, warehouses, and strip malls, bidding prices up and driving returns down to historic lows. It didn't matter if the building made money. It only mattered that you could borrow cheap debt to buy it and sell it to the next guy for a profit. It was a game of musical chairs played with skyscrapers. But in 2022, the music stopped. The Federal Reserve, battling inflation, hiked interest rates at the fastest pace in 40 years. Suddenly, that free money wasn't free anymore. The 3% loan you used to buy that office tower? It's now refinancing at 7% or 8%. And here is the brutal math. If your interest payments double, but your rental income stays the same, your profit doesn't just go down, it vanishes. You are underwater. This brings us to the core mechanism of the collapse. We aren't just dealing with high rates. We are dealing with a triple whammy that has never happened before in history. Factor 1. The structural shift. The pandemic didn't just pause office work. It broke the habit permanently. As of 2025, office vacancy rates in the U.S. have hit a record 19.6%. Factor 2. The valuation collapse. When vacancy goes up, the building's value goes down. It's simple supply and demand. But because these buildings were bought with massive leverage, a 20% drop in value can wipe out 100% of the owner's equity. We are seeing office towers in St. Louis and Los Angeles selling for 50% to 60% less than they sold for just 5 years ago. Factor 3. The maturity wall. Commercial loans aren't like your 30-year home mortgage. They are short-term, usually 5 to 10 years. At the end of the term, you have to pay back the full principal, usually by getting a new loan. But today, banks don't want to lend on offices. And even if they did, the new rates make the payments impossible. Landlords are trapped. They can't refinance, they can't sell, and they can't pay. We've established that the buildings are empty and the loans are coming due. But you might be thinking, I don't own an office tower. Why should I care if a private equity firm loses $1 billion? Here is where the story gets dark. It's not about the billionaires, it's about your bank. The biggest holders of commercial real estate debt are not the too-big-to-fail giants. It is the regional banks. Data shows that small and mid-sized banks hold nearly 70% of all outstanding commercial real estate loans. For some of these banks, their exposure to CRE is 300% of their total capital. Here is the nightmare scenario. A bank lends $100 million on a building. If that building's value drops by 40%, the collateral is gone. If the borrower hands back the keys, which they are doing in record numbers, the bank takes the loss. If a bank takes enough of these losses, its capital buffer is wiped out. It becomes insolvent. This triggers the urban doom loop. As property values crater, city tax revenues plummet. Cities like New York and Chicago rely heavily on commercial property taxes. Less tax money means cuts to subway services, sanitation, and police. That leads to higher crime and dirtier streets, which causes more people and businesses to leave, driving property values down even further. It is a self-reinforcing downward spiral. So why hasn't the whole system collapsed yet? Because of a strategy industry insiders call extend and pretend. Banks are quietly allowing borrowers to extend their loans, pretending that the building is still worth what it was in 2019, just to avoid booking the loss. They are hoping that if they wait long enough, rates will drop and values will recover. But the data suggests time is up. Delinquency rates are surging. When the maturity wall hits in full force in late 2025 and 2026, the extensions will run out. So, what happens next? Scenario A. The soft landing. The Fed cuts rates aggressively, and the crisis is contained. Scenario B. The hard reset. Rates stay higher for longer. The maturity wall breaks the regional banks, leading to a wave of consolidations where giants like JP Morgan gobble up smaller players for pennies on the dollar. The collapse of the commercial real estate market isn't a possibility. It is a mathematical certainty already in motion. The days of the glass tower dominance are ending, but in every crisis, there is opportunity. The smart money is already looking at how to convert these ghost towers into residential spaces, data centers, or vertical farms. The destruction of the old capital is the fertilizer for the new. The only question remaining is your money in a bank that's holding the bag? Because when the music truly stops, there won't be enough chairs for everyone. If you want to stay ahead of the curve and understand the mechanics of the next global shift, make sure you are subscribed. I'll see you in the next deep dive.